Learning outcomes. After studying the module, you shall be able to know about foreign exchange market, learn direct and indirect quotes, cross rate, spot and forward rates. Identify various currencies of different countries. Evaluate the foreign exchange transaction. Analyze foreign exchange trading. Introduction. The foreign exchange market. There is a growing need of business firms to operate in other countries. They set up their factories or subsidiaries abroad to enter international markets. If there were a single international currency, there would be no need for a foreign exchange market. When a firm decides to establish foreign subsidiary and to expand into foreign markets by exporting goods and services or forming joint ventures with foreign investors, the understanding of foreign exchange market becomes important. The institutional setup that facilitates the exchange of currencies is known as the foreign exchange market or the Forex market or FX market. In other words, it is the market where one currency is exchanged for another currency. The Forex market is not physically located at a certain place. Rather, it is an electronically linked network for a large number of individual foreign exchange trading centers. The foreign exchange rate. Depending on the perspective of the participant, a currency is identified as the domestic or home currency or as a foreign currency. From the perspective of an Indian participant, Indian rupee is a home currency and any other currency is a foreign currency. The rate at which home currency is exchanged for a foreign currency is known as Forex rate. In general, a Forex rate is a price of one currency quoted in terms of another currency. For example, the price of rupee in terms of US dollar is the exchange rate of which INR can be converted into US dollar and vice versa. Forex trade involves the purchase of one currency and the sale of another currency. Now, let us see the foreign exchange quotations, direct and indirect quotations. Quotations in the foreign exchange market can be made in terms of local currency or domestic currency or in terms of per unit of a foreign currency or vice versa. The quote may be denoted as direct or indirect. For example, an exchange rate of US dollar 0.01665 per Indian rupee means that the price of 1 rupee is 0.01665 dollar. When the rate is written as US dollar 0.01665 per rupee, it is referred to as indirect quote. An indirect quote thus indicates the number of units of foreign currency that can be exchanged for 1 unit of domestic currency. This rate can be expressed in another way also. We can say that the price of 1 US dollar is 60.06 rupees, that is 60.06 per US dollar. This referred to as direct quote. A direct quote indicates the number of units of domestic currency that can be exchanged for 1 unit of foreign currency. The direct quote and indirect quote are related to each other in an inverse relationship. That is, an indirect quote is the inverse of direct quote. So, in a formula we can show it: indirect quote is equal to 1 divided by direct quote. So, this formula shows a inverse relationship between the two. Now, both direct and indirect quotations are useful in foreign transactions. For example, if direct quote of euro in US is euro 1.36872 and American importer has to pay euro 1000 to a European firm, then how many dollar will be required by American importer? In this case, the quote for dollar per euro may be obtained as the inverse of euro per dollar, that is 1 divided by 1.36872 is equal to 0.73061. So, he will require 0.73061 into $1,000, that will be equal to $730.61 to pay for the European firm. Now, let us see two-way quotations. In the forex market, market makers are always ready to buy or sell currencies by quoting two prices, one by buying the foreign currency known as bid price and another for selling the foreign currency known as ask price. The bid price is the price at which the market maker giving the quotation is ready to buy foreign currency in exchange for a domestic currency. On the other hand, the ask price is the price at which the market maker is ready to sell foreign currency for the domestic currency. Since dealers expect profit in foreign currency operations, the two prices cannot be the same. The dealer will buy the foreign currency at a lower price and sell the foreign currency at a higher price. For this reason, the bid price is always less than the ask price, and the difference between the two is known as ask bid spread. So, the formula is ask bid spread is equal to ask price minus bid price. In percentage terms, spread can be expressed with reference to bid price or ask price in the following equation. Spread percentage is equal to ask price minus bid price divided by ask price into 100, and spread percentage is equal to ask price minus bid price divided by bid price into 100. For example, if the ask price is of dollar per pound is 1.7151 and the bid price is $1.7132, then the spread may be calculated as follows. When reference to bid price, spread percentage is equal to 1.7151 minus 1.7132 divided by 1.7132 into 100 is equal to 0.1109%. With reference to ask price, spread percentage will be 1.7151 minus 1.7132 divided by 1.7151 into 100 is equal to 0.1107%. Now, let us learn about spot and forward transactions. When two parties agree on a forex transaction, the actual exchange of currencies takes place at a date known as settlement date. This date may be any date after the deal date. Depending upon the time gap between these two dates, that is the transaction date and the settlement date, forex transaction can be classified as spot transaction and forward transaction. Spot transactions and spot rates. Spot transactions refers to the transactions done in the spot market. Spot market is the market where the transactions are conducted on an immediate delivery basis. Though the term immediate gives an impression of instantaneous delivery, but delivery actually takes place within 2 days of transaction date, and the rate at which transactions takes place is known as spot rate. In other words, spot rate is that exchange rate which is applicable to the purchase and sale of foreign exchange on an immediate delivery basis. In the spot exchange market, spot rates may be denoted as direct and indirect rates. Also, spot are quoted in terms of ask price and bid price, and the difference between the two, that is spread, is equal to ask price minus bid price, forms the dealer's profit. Now, let us see about forward transaction and forward rate. In a forward transaction, the parties enter into a contract called the forward contract, which permits the sale and purchase of a foreign currency at an agreed upon exchange rate at a specified future date. Thus, forward transactions do not require immediate settlement. They are settled on any predetermined date after the transaction date. The settlement date of forward transaction may be 30, 60, 90, 120 or 180 days after the deal date. A forward transaction, depending upon the number of days in which it will be settled, referred to as a 30-day forward, 60-day forward, 90-day forward, and so on. Forward transactions are very flexible and can be tailored to meet the specific needs of a trader with respect to currency, amount and settlement date. The market for forward transaction is known as a forward market, and the rate at which forward transactions are settled on a future date is called the forward exchange rate or the forward rate. A forward exchange rate occurs when buyers and sellers of foreign transaction agree to deliver the currency at some future date. The concept of future rates is equally significant and relevant to the seller or exporter. Suppose the Indian firm sells goods of a value of $12 million on a 6 months credit. To eliminate the uncertainty of the US dollar rupee exchange rate, the Indian firm may enter into a contract of selling $12 million 6 months from now. For example, on January 1, an Indian firm exports goods of the value of $10 million on 6 months credit. On January 1, the 6-month forward rate is rupees 61.50 per US dollar. The firm agrees to sell $10 million at rupees 61.50 on July 1st. By entering into such a contract, the Indian firm has assured itself of the receipt of $10 million multiplied rupees 6150, that is 615 million rupees on this date. Irrespective of the spot rate prevailing on that date, suppose that the actual spot rate is rupees 60.50 per US dollar on July 1st. The Indian firm has gained 10 million rupees. Gain 10 million rupees is equal to actual receipt, that is rupees 615 million minus rupees 605 million in the absence of forward contract. The above example highlights that the forward rate contracts eliminate exchange rate risk. This happens when the actual spot rate on the date of settlement turns out to be unfavorable to the business firm hedging the risk. The actual spot rate on that day may be lower or higher than the forward rate agreed on the date of the transaction. In the forward exchange market, the forward rates can be at a premium or discount. If forward rate is higher than the actual spot rate, it implies that forward rate is at premium, or more amount of domestic currency is required to be paid in future to purchase an amount of foreign currency. On the contrary, the forward rate is lower than actual spot rate implies that forward rate is at discount, or less amount of domestic currency will be required in future to purchase an amount of foreign currency. The forward premium or discount usually expressed in the form of percentage and can be computed as follows. Forward premium, it's a discount, is equal to forward rate minus spot rate oblique spot rate multiplied by 360 divided by number of days in the contract multiplied by 100. A positive percentage value means a forward premium and a negative percentage value means a forward discount. Now, let us see what is forward premium. Forward premiums and discounts are not into annual terms by dividing by n, because interest rates are quoted in per annum terms. This is actually useful to compare interest rate and forward premiums and forward discounts in these same terms. Also, forward premiums and discounts are put in percentage terms by multiplying by 100. For example, if the forward rate is rupees 60.6 per dollar and the spot rate is 60.5 per dollar and n is equal to 1 month, then the percentage per annum premium on dollar is forward premium is equal to whole bracket, then curly bracket, 60.6 minus 60.5 divided by 60.5 whole bracket close, multiply 360 divide by 30 and whole multiplied by 100. So, we get an answer of 1.98%. In case the forward rate is less than the spot rate, then the percentage per annum discount may be calculated in the same way. For example, if the forward rate is rupees 60.3 per dollar, the percentage per annum discount on dollar is forward discount is equal to 60.3 minus 60.5 divided by 60.5 whole multiplied by 360 divided by 30 into 100, which gives the answer of 3.97%. Forward quotations. Two types of quotations are made in the foreign word exchange market: outright rate and swap rate. The rate which is made in terms of local currency at which the dealer will buy or sell a foreign currency is known as outright rate. When forward rate is quoted in terms of points of difference, that is discount or premium, from the spot rate is called swap rate. The outright rate is the spot rate adjusted by the swap rate. Even though some forward contracts are outright, the convention in the market is to quote all forward rates in terms of the spot rate and the number of swap points for the forward contract. For example, the 180-day forward Canadian per US dollar would be quoted as spot 6-month swap 1.0582 to 90 and swap is 25 to 29. The spot rate means that the bid on US dollar is Canadian dollar 1.0582. The quoting bank is willing to pay Canadian dollar 1.0582 per US dollar, and the ask on US dollar is Canadian dollar 1.0590. The quoting bank will sell US dollars for Canadian dollar 1.0590 per US dollar. The swap points 25 to 29 must be added to or subtracted from the spot bid and ask rates. Whether there is a need to add or to subtract depends on whether the two numbers in the swap points are ascending or descending. If the swap points are ascending, they are added to the spot rates so that the bid on US dollars for 6 months ahead is Canadian dollar 1.0582 per US dollar plus Canadian dollar 0.0025 per US dollar is equal to Canadian dollar 1.0607 per US dollar. Thus, the quoting bank is bidding Canadian dollar 1.0607 on the US dollar for 6 months forward. In other words, the quoting bank is willing to buy 6-month forward US dollar or sell Canadian dollars at Canadian dollar 1.0607 per US dollar. This is the 6-month outright forward rate. Similarly, the outright ask on US dollars for 6 months ahead is Canadian dollar 1.0590 per US dollar plus Canadian dollar 0.0029 per US dollar is equal to Canadian dollar 1.0619 per US dollar. The quoting bank is willing to sell forward US dollars and buy Canadian dollars for Canadian dollar 1.0619 per US dollar. The need to add swap points in this case is due to the ascending order of the swap points. If the numbers are reversed, the points would have to be subtracted. For example, suppose the Canadian dollar had been quoted as spot 6-month swap is equal to 1.0582-19, swap rate 29 to 25. The bid and ask on the US spot rate are the same as before. That is, bank bids Canadian dollar 1.0582 on the US dollar and ask Can dollar 1.0590. The outright bid on the US dollar for 6-month forward is Canadian dollar 1.0582 per US dollar minus Can dollar 0.0029 per US dollar, that is equal to Canadian dollar 1.0553 per US dollar. That is, the bank is willing to buy US dollars for Canadian dollar 1.0553 per US dollar. Similarly, the ask on the US dollar for 6-month forward is Canadian dollar 1.0590 per US dollar minus Canadian dollar 0.0025 per US dollar is equal to Canadian dollar 1.0565 per US dollar. While the rule for adding or subtracting points depending on whether they are ascending or descending. In case of the foreign currency quoted per unit of domestic currency, adding points means that the foreign currency is at a forward discount. There is more foreign currency per US dollar for forward than for spot delivery, and if swap points are in descending order means the foreign currency is at a forward premium. Therefore, it is necessary for foreign currency traders to think quickly and accurately. Now, let's learn about cross rate. There are thousands of pairs of exchange rates with more than 200 currencies in the world, but one is not required to know all these pairs of exchange rates when there is a parity in the exchange rate. A foreign currency can be bought with the domestic currency or with another foreign currency. For example, the US dollar can be purchased directly with Indian rupees, but it can also be purchased indirectly by using Indian rupees to buy British pounds and then using British pounds to buy US dollars. If there is no transaction cost, then there is no difference between buying a foreign currency with home currency directly and buying it indirectly through another foreign currency. With zero transaction cost, this implies that USD per INR is equal to GBP per INR into USD per GBP. The rate of exchange between any two currencies, say I and J, is determined through the medium of some other currency, say K, is known as a cross rate. In other words, the exchange rate which is obtained by cross product of two exchange rates is called cross rate. This can be expressed as follows: I divided by J is equal to I divided by K multiplied by K divided by J. For example, an American trader gives the following quotation in New York: $1.32 per euro and $0.17 per rupees. Then the cross rate for euro per rupees can be ascertained as follows: euro per rupees is equal to euro per dollar multiplied by dollar per rupees, that is 1 divided by 1.32 multiplied by 0.017. So, we get euro 0.013 per Indian rupees. Now, let us see the summary. The institutional setup that facilitates the exchange of various currencies is known as the foreign exchange market. The rate at which the domestic or home currency is exchanged for a foreign currency is known as the foreign exchange rate. There are two kinds of exchange rate quotations. First, direct quotations, and second, indirect quotations. A direct quote refers to the number of units of home currency that can be exchanged for 1 unit of a foreign currency, while an indirect quote refers to the number of units of a foreign currency that can be exchanged for 1 unit of home currency. depending upon the time gap between the transaction date and the settlement date. Foreign exchange transactions can be categorized into spot transactions and forward transactions. Spot transactions are for immediate delivery and forward transactions involve settlement at a certain date in the future. Banks always quote two rates, the bid rate and the ask rate. Bid rate is the buying rate for the bank and the ask rate is the selling rate for the bank. The difference between the two rates forms the bank's profit and known as bid-ask spread. If forward foreign exchange rate is greater than the spot rate, the foreign currency is at a forward premium, and if it is less than the spot rate, the foreign currency is at discount. The rate of exchange between two currencies as determined through the medium of some other currency is known as a cross rate.